Good afternoon. Thank you, Charlie. Thank you very much. I'm delighted to participate in the 3686 Entrepreneurship Festival. I'm going to speak for, I hope, about 25 minutes about key capital formation initiatives at the SEC. After my remarks, I'll be joined by Bill Hinman, our Director of the Division of Corporation Finance, for a fireside chat that's going to be hosted by Governor Bill Haslam. I want to especially thank the Governor for joining us today. The 3686 Entrepreneurship Festival is a fitting place to discuss the Commission's capital formation priorities. While many people visit Nashville because of its rich history and legendary music scene, Bill and I are here today as fans of the Music City's vibrant ecosystem for startups. Nashville's array of incubators, accelerators, co-working spaces, and startup competitions, in combination with active angel investor and venture capital communities, provides fertile ground for startups to get traction and then thrive. These statistics are amazing. Nashville was ranked 6th out of the top 40 US cities for entrepreneurs and startups in 2018, and 7th among US cities creating the most tech jobs in 2017. 6th and 7th are pretty darn impressive for a city with the 25th largest population. We should celebrate this success. We also should recognize that Nashville's success stands out geographically. In other words, our innovation and financing hotspots are few and far between once you leave a few states on the coasts. In the first quarter of 2018, California, Massachusetts, and New York received more than 78% of all equity financing for venture-backed companies. Together, those 3 states have 20% of the US population. Compare that to Tennessee and 39 other states that in aggregate receive less than 6% of the total, while those states have 45% of the US population. There are obviously a lot of miles and many very good and talented people and promising companies between the coasts. And we at the SEC want to make sure our regulation of capital formation enables capital to flow to the areas in between. If we see obstacles preventing the efficient flow of capital to these areas, we should be striving to break them down, while at the same time being always mindful of our commitment to investor protection. In particular, I believe the SEC should be keenly focused on helping small businesses from coast to coast access capital to grow, create new jobs, and in turn, provide investors, including our Main Street investors, expanded investment opportunities. That is why we have been reaching out to and engaging with businesses across the country. We should also recognize, importantly in our analysis at the SEC, that there are many connections among small, medium, and large businesses, long-term investment capital, and importantly, human capital. Focusing on investment capital, we have met with many companies at different stages of the growth cycle and have gained a better understanding of the regulatory and other challenges they face when raising capital. For example, in my first few months at the SEC, we hosted a small business group from across the country, from places including Arkansas, Idaho, Michigan, Montana, and North Carolina. We discussed the regulatory requirements and other considerations that factor into the decision to stay a private company or go public, including the complexity of disclosure requirements and the compliance costs of various components of the Sarbanes-Oxley Act of 2002. Last October, Bill and I attended a high-tech job summit in Montana to discuss job creation and capital formation. And last November, the SEC held its annual Government Business Forum on small business capital formation in Austin, Texas. This was the first time this event was held outside of Washington, D.C. in more than a decade. And I'm pleased to be able to continue the ongoing dialogue here in Washington. I often deviate from my prepared remarks. I'm going to do that here. my staff gets nervous, but let's say this anyway. It's wonderful to be in a place like Nashville and engage with you, engage with the governor, because in Washington, most of the people you talk to are paid to talk to you. Here, I hope you're here because you want to talk to us. I want to now share with you the efforts the SEC has undertaken over the last 16 months that are intended to foster capital formation and what you should expect from our upcoming regulatory agenda, both with respect to public registered offerings and offerings exempt from registration with the SEC, what we call private placements. Before I do so, I want to say a few words about initial coin offerings, or ICOs. No conversation about recent efforts at the SEC to foster innovation would be complete without mentioning our approach to distributed ledger technology, digital assets, and ICOs. Our efforts in this area embody two principles that the SEC has followed for decades. First, embrace new technologies that cut costs and provide investment opportunities. I think distributed ledger technology has enormous promise in this area. Second, continue to require that our retail investors have access to the material information that is necessary to make an investment decision, including the key risks involved. As I've said before, those seeking to raise capital to fund an enterprise, which many in the ICO space have sought to do, need to consider whether they are engaging in an offer and sale of securities. If they are, it places that activity squarely within our jurisdiction. Determining what falls within the ambit of a securities offer and sale is a facts and circumstances analysis, where we use a principles-based framework that has served American companies and investors well for over 80 years. Bill Hinman recently outlined the approach we take to evaluate whether a digital asset is a security, and I encourage you to take a look at Bill's speech, which is available on our website. If you are considering jumping into this space, I also encourage you to reach out to us, to reach out to the Division of Corporation Finance. They have built significant expertise in these areas and recently named a new associate director to serve as the senior advisor for digital assets and innovation. Her job is to coordinate our efforts in this area across the agency. Our door is open to those who seek to innovate and raise capital in accordance with the law. Now switching to our efforts to promote capital formation. I believe the Jumpstart Our Business Act, the Jobs Act, the Jumpstart Our Businesses Startups, Jobs Act in 2012, and the Fix America's Surface Transportation, the FAST Act in 2015. That's the Jobs Act and the FAST Act, both of which had bipartisan support in Congress, set an effective regulatory modernization framework for the SEC to build upon. Let me say that in simple words. Both of these acts reflect the principle that one size does not fit all. Over the last year, the SEC is taking meaningful steps to reduce regulatory burdens on pre-IPO and smaller companies, while maintaining and in some areas enhancing investor protections. The importance of this focus is highlighted by the significant decline in public companies over the last 2 decades, particularly amongst emerging companies. Understanding and addressing this trend, a problem for which, unfortunately, no single policy initiative exists, will, I believe, yield significant benefits for our retail investors as well as emerging companies themselves. I'm going to deviate again. Let me try and sum this up. We have many fewer companies going public as they're in their growth cycle. What this means is less opportunity for capital for those companies and less opportunity for participation by our retail investors. Both those things, I think, should concern us. If we improve that, investors in these types of companies will have access to investment opportunities in more companies and will benefit from stronger and more complete disclosure than they would likely receive if emerging companies continue to eschew the public markets as a matter of course. This is particularly the case for Main Street investors who generally do not have the opportunity to invest directly in high-quality private companies. As examples of our commitment to promoting capital formation, I want to highlight three categories of actions in the public company space. First, a scaled disclosure framework for smaller companies. Second, disclosure modernization and simplification. And third, extensive staff guidance helpful to the IPO process. Going to scaled disclosure. For smaller companies to flourish after an IPO, we need to continue to focus that a one-size regulatory structure for public companies does not fit all. One illustration of the right sizing of regulation is the Commission's June 2018 expansion of the number of companies that qualify as smaller reporting companies, or SRCs. The Commission had established this category of companies in 2008 in an effort to provide regulatory relief for smaller companies by allowing them to provide scaled disclosures, which in turn reduced compliance costs. However, the threshold to qualify as an SRC had not been updated for a decade. The new definition enables companies to qualify as an SRC if its public float is less than 250 million, an increase from the previous 750 million. In addition, our new rule expands the definition to capture companies with less than 100 million in annual revenues if they have either no public float or a public float that is less than 700 million. The new definition goes into effect next month and will allow an estimated 966 additional companies to claim SRC status in the first year. Another area where we should ask ourselves if we have the appropriate framework to support smaller public companies is secondary market liquidity. It's fine to go public, but once you go public, does your stock trade well? Stock trading well is good for both the company and for investors. If it doesn't trade well, the company doesn't do well. If it doesn't trade well, investors can't get in or out when they want to. In April of 2018, our Division of Trading and Markets hosted a roundtable that explored the market structure for the securities of smaller, more thinly traded companies. Our goal is to make sure that our market structure meets the needs of all companies, both large and small. The SEC staff is analyzing a number of the suggestions and comments made at that roundtable, and more generally is considering ways to improve secondary market liquidity for smaller companies. I'll turn to disclosure modernization and simplification. It's important for us to review our regulations to ensure that they are consistent with our ever-evolving capital markets. These efforts tend not to garner much public attention, but they are particularly consequential with respect to our disclosure rules. In October of 2017, we proposed amendments to streamline the rules and forms that public companies use to provide information to investors. We received helpful comments, many of them supporting our proposal, and the staff is working on final recommendations for the Commission's consideration. The Commission has also taken steps to simplify and update financial disclosures. Last month, we proposed amendments to financial disclosures to encourage guaranteed debt offerings to be conducted on a registered rather than a private basis. It's a lot of words. Guaranteed debt, to issue it in the public market, became highly complex from a financial statement presentation point of view, so much so that people moved to the private market. We're trying to bring them back to the public market. I believe that this measure will save issuers significant time and expense. It will enhance the quality of the financial disclosure and increase investor protection. Also, just 2 weeks ago, the Commission adopted final rules that simplify and update disclosures by eliminating requirements that are outdated, overlapping, or duplicative of other rules, or duplicative of US GAAP. While these rule changes may appear technical, I anticipate that they, taken together with other capital formation initiatives, will yield substantial benefits for public companies and investors. Importantly, they will not adversely affect the availability of material information to investors, and in many cases will enhance the quality of information and increase investor protection. Finally, guidance that the staff has provided. We've been trying to facilitate the IPO process with extensive guidance. The Job Acts gave us a new category of companies, emerging growth companies. These companies have the flexibility to start the SEC review process for IPOs on a confidential basis. The Division of Corporation Finance has expanded this process to all first-time registrants and newly public companies conducting IPOs and other offerings within 1 year of an IPO. This is significant because it gives all registrants who are entering our public markets more control over their offering schedules and limits their exposure to market volatility and competitive harm, again, without in any way diminishing disclosure or investor protection. In the past 13 months, the Division of Corporation Finance has received draft submissions for more than 40 IPOs and from over 75 companies engaged in offerings within 1 year of an IPO. The Division of Corporation Finance also provided registrants with guidance on the preparation of financial statements. They did so with the goal of identifying areas where flexibility could reduce burdens and costs without materially altering the total mix of information available to the public. In particular, the staff provided greater clarity about what financial information is required when submitting a draft registration statement. This allowed registrants to avoid the time and expense of preparing and filing interim financial information that would be superseded by the time the filing was first made public. This sounds pretty simple. Why should we require you to file something if you're not going to have to use it when you go public? We got rid of that problem. The Division of Corporation Finance, in combination with our Office of Chief Accountant, also provided guidance promptly after the enactment of the Tax Cut and Jobs Act, anticipating that public companies would face challenges to account for a very significant change to the U.S. federal tax code. In effect, telling our public companies we were thinking about the challenges that other laws would present for them when they were trying to comply with our regulations. I want to applaud my colleagues in the Division of Corporation Finance and in the Office of Chief Accountant for thinking ahead on behalf of our registrants. Let me go now to our future-looking agenda. Despite all these efforts, I believe more must be done to encourage capital formation for emerging companies seeking to enter our public capital markets. Over the next several months, I expect the Commission will be taking a fresh look at the thresholds that trigger Section 404B of the Sarbanes-Oxley Act of 2002. While Section 404B is an important component of our public company regulatory regime, we have heard from market participants that particularly for smaller companies, the costs associated with this requirement can divert significant capital from the core business needs of companies without any meaningful benefit. Currently, companies with a public float of less than 75 million, or if no public float, annual revenues of less than 50 million, have relief from Section 404B auditor attestation requirements. Importantly, and I believe that this is often misunderstood, those companies are still required to establish, maintain, and assess the effectiveness of their internal controls over financial reporting. And even if not engaged to report pursuant to 404B on those internal controls, independent auditors are still responsible for considering those internal controls in the performance of their financial statement audits. I believe this scaled approach has proven appropriate for smaller reporting companies and again reflects the perspective that one-size regulation of public companies does not fit all. Let me give you a few stats here. Our 50th largest public company has a market cap of approximately $100 billion. However, our median public company, and there's only roughly 4,500 public companies, our median public company has a market cap of less than $1 billion. That's a 100x difference. In addition, there are more than 1,200 exchange-listed companies that have a market cap of less than $250 million. We shouldn't have the same regulatory approach to $100 billion that we have to $250 million. I also believe that there may be other categories of small and emerging companies where a scaled approach may be appropriate. For example, for a biotech company that has routine financial statements and no revenue, the money that goes to pay for the Section 404B auditor attestation report could instead be used to hire new scientists who may advance life-enhancing or life-saving developments. I have directed the Commission staff to formulate recommendations for possible amendments that would reduce the number of companies that need to provide auditor attestation reports required by Section 404B, while, and this is critical, maintaining appropriate investor protections. They are actively working on this project, and I look forward to considering their recommendations. In addition, the staff is working on a recommendation to expand the ability of companies who are contemplating raising capital to test the waters. The Jobs Act permitted emerging growth companies to test the waters. That is, engage in communications with certain potential investors prior to or following the filing of a registration statement for an IPO with us. I've seen firsthand how this has benefited companies considering an IPO, as they are able to obtain feedback in the advance of an offering. This benefits the company. It also benefits investors and shareholders, as their companies are better able to determine the appropriate time for an offering and the appropriate price for an offering. I look forward to considering this initiative going forward. Now I'm going to shift away from public companies, because capital formation is equally important for private companies, including many of the entrepreneurs here in Nashville today. We need an environment that nurtures the growth of a company through its business cycle, from the idea to the launch of the business, to the pains that come with growth, to maturity and profitability. Congress and the SEC have taken a number of steps to expand the options that small businesses have to raise capital. Small businesses today have more options to reach investors within their state using an interstate exemption, or to tap the crowd using the power of crowdfunding. Small businesses can decide to limit their offerings to sophisticated investors in reliance on Regulation D, or open those offerings to retail investors using Regulation A. Since these various rules have gone into effect, and please follow these stats, small businesses have conducted over 900 offerings that report raising more than $90 million collectively using regulation crowdfunding. And there have been over 300 offerings raising a total in excess of $1 billion pursuant to Regulation A. Those amounts, however, are eclipsed by the $147 billion reportedly raised in 2017 using 506C of Regulation D, the new exemption that lifted the ban on general solicitation. And that is even dwarfed by the use of traditional private placement exemptions, where over $1.7 trillion was raised. What am I saying? We've done some things. They've been helpful, but they're small in comparison to the traditional private placements that are mostly available to large, sophisticated investors. We also recently expanded the exemption that permits private companies to issue securities to employees, consultants, and advisors as compensatory awards. And we're soliciting comment on further ways to modernize the rules related to these compensatory arrangements. This is important because the so-called gig economy has changed how companies and individuals design alternative work arrangements, and therefore, individuals who you want to compensate with equity may not be employees, and we need to be flexible. I encourage all of you to review this concept release and provide us with feedback on how we can improve our rules. While the options to raise capital and exempt offerings have grown significantly since the Jobs Act, there hasn't been a comprehensive review of our exemptive framework to ensure that the system as a whole, all those exemptions I mentioned, is rational, accessible, and effective. In fact, I doubt anyone would have come up with anything close to the complex system we have today if they were starting with a blank slate. So I believe that we should take a critical look at our exemption landscape, which can be fairly described as an elaborate patchwork. We're going to embark on this project, and as we do, we should evaluate the level of complexity of our current framework and consider whether changes should be made to rationalize and streamline that framework. For example, do we have overlapping exemptions that create confusion for companies trying to navigate the most efficient path to raise capital? Are there gaps in our framework that impact the ability of small businesses to raise capital at key stages of their business cycle? I'm again going to deviate. There are complex offerings where you need a lawyer of the type that I was in the private sector, but you shouldn't have to hire a high-powered Wall Street lawyer to conduct every private placement. We also should consider whether current rules that limit who can invest in certain offerings should be expanded to focus on the sophistication of the investor, the amount of the investment, or other criteria rather than just the wealth of the investor. And we should take a look at whether more can be done to allow issuers to transition from one exemption to another and ultimately to a registered IPO without undue frictions. The staff is working on a concept release that I expect will bring to the forefront these and other topics on how we can harmonize and rationalize exempt offerings. Input from you, the startups, entrepreneurs, and investors who have firsthand experience with our framework, is extremely important. You've done it. We want to know how we can make it better. I hope you will take time to share your views with us on this topic and any other topic where you feel we can improve. To sum up my remarks, we've taken a lot of steps that are intended to promote capital formation, and we have an ambitious capital formation agenda ahead of us. We're committed to efforts to develop a regulatory framework that equally serves the neighborhood coffee shop that is looking to expand to a second location, the biotech startup that is looking to hire more scientists, the social media company looking to conduct an IPO, and again, importantly, the Main Street investor who is looking to invest and save for the future in emerging companies. Thank you for your attention, and I look forward to our Q&A.
Thank you, Chairman. It's wonderful to have the SEC focused on these kind of issues for our entrepreneurs across Nashville, across Tennessee, and really the entire country because it's so important. So I know this is certainly not an easy task to do this and to help change regulation and open up awareness and opportunities, and it takes a team to do so. You recruited Bill Hinman to join you in that effort. Bill, if you'd come on out, Bill had been out in Silicon Valley with law firm Thatcher, Hiller and Bartlett out there, has been corporate finance, and has moved back to the East Coast where he's from originally and works very closely with Chairman Clayton. So give it up for Bill Hinman here. And this is like the triple crown of speakers, the top two people at the SEC, and now I'm going to ask my boss, Bobby Rolfe, to come out and introduce both of our bosses.
Charlie, thank you. Gentlemen, please have a seat.
Oh, thank you.
So, ladies and gentlemen, my name is Bobby Rolfe, and I have the privilege of serving as our Commissioner of Economic and Community Development for the great state of Tennessee. And the governor asked me to be very short in his introduction. Well, I'm going to comply with that. But I'm going to put it, Mr. Chairman, in SEC terms. If the state of Tennessee was a publicly traded SEC registered company, our annual revenues would be close to $38 billion. 40,000 employees, 6.6 million shareholders, and a CEO and chairman, the 49th governor of the great state of Tennessee, Governor Bill Haslam.
Thanks, Bobby. All right, welcome everyone. Thank you very much for joining us. All right, let me start out with just something that might help us understand the rest of the conversation. Why are you guys doing this? I'm willing to bet that in your previous jobs, the compensation was a little better. You didn't have people that were mad at you about various things that had opinions about your job. So I'd love to ask both of you, Bill and Jay, why are you doing this?
Well, I don't know why Bill's doing it, but I sure am glad he is. But vice versa. For me, I love markets, and I love what this country has been able to do as a result of our approach to markets. Let me give you a stat. We have 4.4% of the world's population. We have 62 of the world's 100 largest companies.
Wow. Well said. Bill?
Well, for me, I think the primary reason was Jay asked me to do it. I was sort of toward the end of my career. My entire career had been in private practice and had done that for 37 years. And knowing that Jay was going to be heading the SEC and had the agenda that he had, and having worked with him in the private sector, I had a lot of confidence that we could do some good things at the SEC. I always had a lot of respect for the division that I now am the director of, and it just seemed like an exciting thing to do at that stage of my career, and it's been about a year and a half, and it's been terrific.
All right, let me, Chairman, you spent a lot of time talking about the number of public companies. I think 4,500 was the amount of listed companies. I think I'm close, and Bill was saying there's some more that aren't listed, but about 4,500, which is half of what it was how long ago?
15 years ago, so.
Okay, so one of your all's missions is obviously to encourage folks toward the public market, so there'll be a market for retail investors and lots of other reasons. But it seems like today, and I bet if we polled out here, is it more or less desirable to be a public company than it was 10 years ago? Most people would vote less. The restrictions are more, the disclosures are more, there's more pressure around compensation, there's just lots of issues. So give us your best pitch if these folks were trying to decide right now, ultimately I want to be a public company or I don't. Give us your best pitch of why they should seriously think about being a public company.
Well, I'll start. There are substantial benefits to being a public company. Liquidity, the ability to raise capital, distribute capital, much more efficient as a public company. Permanent capital, the ability to have permanent capital. There's no obligation to return the capital if you can use it. Those are two differences for a public company from the private company. There are others, the ability to compensate employees more effectively. But let me turn to Bill. I mean, we recognize that, let's put it this way, the private capital market has raised its game. It's not just less attractive to be a public company. There's more available in the private sector than ever before. So we have a couple of dynamics working here.
And that's a good thing, that there is that amount of private capital available. So we don't in any way want to discourage that. We do want to make sure that the hurdle to go public is as low as it can be while still protecting investors. In terms of the advantages, Jay and I both in private practice would see the evolution of a company from that late private stage into the public sector. And those companies got a lot stronger as they had improved governance, better accounting, more accountability to their shareholders. So if you can get there, it's a terrific thing. And then, of course, as Jay's suggesting, the public markets should be a lower cost of capital. Because you have the liquidity and because you have the transparency, ideally investors see that and don't charge the same premiums as they do in the private markets. Now, the regulatory burdens sort of add costs back onto that side of the equation, and that's one of the things we're really focused on, is making sure those are not any higher than they need to be.
You talked also about capital formation, and we had a little chance to talk backstage about really the uniqueness of our country, and you just mentioned it in terms of the percentage of the world's population we are, but the amount of capital that's been generated and the amount of wealth as because of that. Last year, I did this conversation with a guy that started a little homegrown company called FedEx named Fred Smith. And Fred has a chart that he shows that basically shows the amount of capital invested and kind of the growth chart of that and the amount of employment and it tracking the capital invested. How do we, one of your roles I would think is to be an evangelist for our system where people put capital at risk and there's a return associated with that. How do you tell that story? I'm assuming that's one of the roles you both feel that you talk about, just with all of its issues, how well the system does work.
Well, I'm glad you're talking about it, and I think we should talk about it more. I mean, I had the privilege in my career of working in markets around the world. There's no market close to the U.S. market in terms of the nimble nature of capital and the nimble nature of human capital, investment capital and human capital. And we try not to forget that we have regulatory goals, very important ones. But that fundamental principle that you're looking to foster capital investment, that fosters jobs, that fosters human capital growth. I mean, the ecosystem you have here is an example of that. Healthcare, education, entrepreneurship. What you have here in Nashville is a microcosm of the United States.
Bill?
Yeah, I would just echo on the healthcare side and the life sciences, which is obviously a big driver in this region, the ability to access public capital over longer periods of time when you have a long-term product horizon and investment horizon, that's incredibly valuable. So again, we want to see companies join that sphere and have an experience that says, we're glad we did that. So in our division, where we do interface with public companies, we are trying very hard to make sure people recognize us as a collaborative regulator. We're improving our transparency in terms of who you call when you have issues. We're publishing real phone numbers that people answer the phone on. We're trying to do that in a faster way. We're trying to be more efficient. And we're publishing more guidance, as Jay mentioned in his speech, to try to be more transparent. Again, to make the public company experience a little bit more enjoyable than it was, say, in the past.
So it's only one of the things you talked about is companies with a long-term product cycle, and yet one of the big battles that I'm sure any of these folks think about is, my issue is I do have a long-term product cycle, but I have investors with a more short-term view. So what advice would you give this room for helping deal with short-termerism or whatever you want to call it, that's the reality of the investment world today? What advice do you have in helping them to coax investors past that to have a better long-term view?
I think this is on, I know this is on both of our minds, which is, let's take a step back. One of the reasons we are focused on what I call the Main Street investor is when you look at the investing public, the retail investment money, the money that goes into the S&P 500 fund or another index fund, that community, they do invest for the long term. They're putting money away on a monthly basis, and that money is in there for the long term. Question we have is that perspective, that Main Street investor long-term perspective in our equity markets, is it being represented in the boardroom effectively? And it's a good question. And we're looking at ways to make sure that long-term sticky money in the market is represented in the boardroom.
Sure, and this issue's been getting a fair amount of current press. Warren Buffett, Jamie Dimon have put statements out around too much focus on quarterly earnings. The president has talked about it, has asked us to look at the issue. As with any hot issue in the public space, it's something we've been thinking about for a while, and we're happy to look at it in more depth to see what role our regulations play there. We do require companies that are public to report quarterly. Their quarterly reports come out usually after their earnings announcements, and at the earnings announcement time, that's what moves the stock, and that's where guidance is usually given. And people have said that some of that quarterly guidance is what drives a lot of short-termism. So we want to ask the market about this. We're going to probably put out some concept release to get more feedback on that, because some of the dynamics here are things that we do have an impact on, and some are market practices. What is the market demanding of public companies generally? Do they want those that guidance to come out quarterly? Do they need those earnings announcements to come out before the Q? Can we put those two together? We're going to ask, the marketplace for some thoughts about how can we be more efficient there, and how would that affect, the views in terms of whether they're long-term.
Speaking of, you mentioned kind of some of the new worlds we're in. One of those involves the whole digital coin world that we live in. I never thought we'd be talking about initial coin offerings. What is your all's role in analyzing it? Obviously, you have a currency that's being, created out of nothing with hopefully some value behind it, and et cetera. What's the SEC's role in this new world?
Well, let's start with, if you take a particular digital asset, do we have a role? Now,
I'm sorry, do we have a...
Do we have a role?
Okay.
Because is it a security or not? And that's a fundamental question for us. Much of what we've seen in the ICO space, if not all, is a security. It's somebody offering what would otherwise be called a stock as an ICO. And we regulate that, and we're not going to change the way we regulate that. And then there are digital assets that don't have the characteristics of a security, and over those, we don't have jurisdiction. A question in that space is, who does? Should somebody have more jurisdiction than they do? And these are questions that are percolating, including at Congress. I don't know, Bill, you want to supplement?
Sure. When we see people raising funds to start a business and to get an operation going, and people are giving them those funds and getting back a coin instead of a share, that still looks like a securities offering to us. That's why you've heard us say many times, the ICOs that we see are securities and we have jurisdiction over them. It's very interesting to see, and the crowd probably has experience with this. Many people at first thought the ICO was a way to sort of end run the securities laws. If I was offering a token, I wasn't offering a share, I guess the SEC won't care. Well, we saw people using the buzz around ICOs as a way to hype offerings, sometimes with very little basis, and so our enforcement group stepped in and took appropriate action on those kinds of offerings. On the other hand, our group is really focused on, well, this technology that underlies these tokens can be quite valuable. There can be very legitimate ways to use this technology and to build a business around it. And so we work with issuers to do that, and we meet with issuers frequently to do that. One thing that we have seen is that the VC community has gotten to the point where they're encouraging folks that have a coin-based idea or a blockchain idea to raise their funds in more conventional ways, because those are securities offerings, so no need to extend yourself with an ICO type structure, and get your framework built, get the ICO network, wherever you're going to use that token, have that up and running to the point, so that when you issue the token, it's clear that that's used on that network, not as a security, but for its functionality, and you've raised your money separately. And we're seeing lots of folks now sort of make those distinctions and operating that way.
All right, we have time for a couple more questions, and they're both going to be, what sort of advice would you give? So if both of you had a chance to give other people who do what I do in elected office advice or warning or caution about the world that you're in, what would that be? What would the caution be that you give to elected officials about the world that you're in?
So I'm going to be a bit philosophical here. Markets function to allow trading, but they also provide incredibly valuable information in terms of the prices, okay? When something trades at a particular price, that information the value of that information goes way beyond the people who are trading. If you and I look at mortgage rates, we may not be looking for a home, but we look at mortgage rates because we're interested in how much it would cost to buy a home. We look at stock prices because you might be making an investment in a social media company, in a private social media company. You're going to look at the public social media company to see what the price should be. I think we get into trouble, and economies get into trouble, when people feel they can't trust prices. And so when I talk to legislators and people about how you look at your rules, try to drive them so that we can have genuine confidence in the prices that we see in the marketplace. And one of the reasons I really love America is we've had this disclosure-based approach to public companies and the marketplace where you can be pretty confident that the price you see is a reasonable price. And when we've gotten into trouble is when the prices that you see turned out not to be reasonable. And that's how I look at it.
That's great. Bill?
I would look at it just from my own experience over the last year or so in the division, probably talking to Congress a little bit about, please be really thoughtful when you add new regulations to the public company sphere. There's lots of good ideas for regulations and good ideas that get layered onto just the public companies, but not the private companies. And it's in part because we're a convenient agency to administer those ideas. We have a disclosure regime, we distribute companies' filings, we have a review staff, we can give comments, we can ensure compliance. But to the extent the regulations don't go to the core issues that investors are interested in when they're making investment decisions in public companies, ask yourself, is this appropriate just for the public company, or is this a bigger issue that we should look at more broadly? If you just add it to the public company sphere, you've just added another tax to going public, and fewer people will have fewer opportunities to invest in public companies. And it's one of the things that potentially we should be looking at in terms of why do we have fewer public companies at the moment.
Fair. All right, we got a few more minutes left. I'm gonna throw you just a wide open question that you can take anywhere. But as we wrap up, you have a room full of entrepreneurs and investors of different types. What advice do you have for the room? I mean, you all have had very storied careers. You have incredible experience from Silicon Valley to New York and all points in between. What advice do you have for the room in general? And you take off your chairman hat and your director hat and just say, as somebody that's been around and watched a few rodeos, here's some advice I have.
In terms of entrepreneurship, I'm sure you've heard this. It's one of the reasons I'm passionate about it. Having capital and a bit more capital than you think you might need is I would say, a hallmark or a common element of success. You don't want to raise money when you absolutely have to. You always want to have just that little bit more capital to get to the next stage. So I've seen people go through the stages, and the ones that go through with a little bit more capital than they think they need, when there's a speed bump, they're able to deal with it. The ones that are totally thinly capitalized, the speed bump can be devastating.
I guess I would just look back at some of the experiences I had in Silicon Valley, as you mentioned, and think about the companies and the entrepreneurs that were most successful over a longer period of time. And it almost always related to the groups where they were building something that they believed in, and they were passionate about their company and what they were going to accomplish with it. And it wasn't to get rich. It wasn't to make lots of money and cash out into the public markets. It was because they really believed in what they were doing. And those companies, when you see how they operated over time, they tend to be the most successful. When you see things like the dot-com boom, no offense to any Stanford grads here, but the recently minted Stanford MBAs were thinking, how many clicks can we say we have? What can we do? How will this affect our valuation as we want to go public? And they were being driven by the valuation and about the liquidity options that they had, much more than what they were actually trying to do with their business. And those businesses, for whatever reason, didn't have the success rates I saw with entrepreneurs who were just really dedicated to creating a business they believed in because they believed in what they were trying to accomplish with their business.
Two great pieces of advice. Thank you. We're honored to have you here. We appreciate you being a part of the group, and thanks to everybody for being here. Thanks so much.
Everybody, let's stand up and give a great 3686 thank you to these incredibly busy guys spending time with us. Thank you. Thank you. Appreciate it. Okay, we've got 3 incredible sessions now going on 3 to 3:45. One here, one B.B. King's, one George Jones. And then the governor is going to give us more time doing a fireside chat with his dad, founder of Pilot Flying J. So be back here. Stay here for the next session, or if you go to the others, come back after that. And then we have the Innovation Happy Hour powered by Dell at the Acme. Okay, thank you.